Okay, everybody, welcome to another YouTube video. My name is Matt. I am a certified public accountant, and I am going to talk today about tax. We're going to do tax talk here. And this is a topic that I think needs to be addressed. I think there's a lot of people that, they work W-2 jobs mostly. Nothing wrong with that. But this is an important topic. And I'm noticing a lot of, at least on my end, there are clients that are shocked at what they owe. And I think we just need to have a primer as to why that is. So before I go any further, if you are enjoying my videos, there are 4 simple things I want you to do. First, like this video, subscribe to my channel. Third, share it with your friends. And then lastly, hit the bell so you get alerted when new content comes out, new videos. So I want to talk about a couple of things, because what people don't understand is the difference between tax due, tax refund, and tax withholding. And so what ends up happening, and what I end up seeing is a situation like this, where, and this marker sucks. This is your tax due. Okay? And then what'll happen is, like, you'll have this much tax. And I'm going to, W/H is withholding. You'll have this maybe from your first job, maybe your spouse works, and they have some withheld. Maybe you started a new job. And then this difference here is your tax due. Now, what's the issue here? The issue is this tax due. Let's put a line on the bottom here and make it like a bar graph here. So we'll make it a little lean. Your tax due. That is what it is. And I'm assuming that you're doing tax planning, you're doing whatever you can to lower your taxes. But at the end of the day, that number on your return is your total tax is what you owe. Okay? Now, assuming you didn't make any estimated payments and you work in these jobs, they're withholding out of your paycheck. Now, the focus is going to be on how they're withholding and what people are doing. And this is where we need to focus, but let me finish this. So people could have multiple jobs, they could have a spouse that works, whatever. You have other income that you're not paying tax on, like brokerage income, like capital gains, stuff like that. But then you have this void up here. What is that? Well, that's how much tax you owe, because what the return is doing when you file that return is capturing all of your activity in the year. And then this is the tax that you owe on it. And then you're applying whatever payments that you've made towards that bill on that return. So what ends up happening is people think, oh great, I got a big refund. Well, no, you paid too much in. That's not free money. You gave the government an interest-free loan. They're just going to pay you back the extra that you paid in. You over withheld. In that situation, I would recommend reducing your withholding. Now, on the flip side, what ends up happening also is people paying too little, and then they're like, well, you must have did something wrong, Matt, because I owe so much. It's like, no. The situation I had the other day, couple, they made $250,000 a year, and they only had about 10% of that withheld, if even that. When you're making $250,000, that even as a married couple, you are going to be in the 24% bracket at that point. You're going to be, so you're going to have some income that's taxed at 10, some at 12, but most of your income is going to be taxed at 22 and 24%. So with that being said, what does that do? Well, that means that you're going to have a big tax bill, because if you're only having 10% of your income, 10% of your income withheld for income taxes, and you're in the higher bracket than that, you're going to owe. And that's the issue. And so that comes to a surprise to a lot of people, and it creates a lot of upset clients. But I think we just need to have the education, and I think it starts with, and again, this is focused on people that are employed, because it's an important topic. And what I'm talking about here is the Form W-4. So what the Form W-4 is doing is it's telling your payroll department, hey, this is my tax situation, and use this to figure out how much you should take out of my paycheck for income taxes. So they take whatever you fill out on that form, put it in their system, and that's what is going to automatically set how much is taken out of your paycheck. That's not set by the gut. There's a tax table and all of that formula that gets used, but whatever you fill out on that piece of paper is what they will do. And so that is important to know, because what happens in the situation where you have job 1, job 2. So let's say this is your spouse, and this is you. And let's say this one makes 100K, and let's say your spouse makes 300K. So it's a big difference, okay? So if you guys file married, this here, well, you're going to be taxed. That's going to be the 32% bracket. You're getting up there. So you're going to have a lot of income tax at 22, 24, and the 32%. You're going to have a big wide range here. Now, the problem is, here's the problem with this, is let's just focus on you. Ignore the spouse. When you fill out your W-4, you might say, okay, I'm married, maybe you have 2 kids, and you'll put that in there. What they're doing is they're saying, okay, what they're assuming is your only income is this job. They're not even thinking about this. They're not even looking at this. They're only looking at this. Your payroll department doesn't know about this. They don't know. You know why? Because you didn't put on here extra withholding. You didn't put anything in here about it. So this is being blocked, okay? And the form tries to tell you, like, hey, if you have multiple jobs, earning spouse, like, you might want to have, it tells you that. And there are tools, we'll talk about those in a second, but when you fill it out and you just say, I'm married with 2 kids, withhold like that, they're withholding as if your total income is only $100,000, and which is still great income. I'm not saying it like that, but I'm saying, like, you're saying only $100,000, and you have no other money coming in. None of this. That doesn't exist. So then you're married with 2 kids. So what's going to happen is you're probably not going to have enough withheld. You're definitely not going to have a third of it withheld, which is probably what you need to be at. But you're just going to have, they totally ignore this, okay? That's ignored. So what happens is you could have what happens if you switch jobs in the middle of the year, and then you made 100K the first 6 months, and then you make 100K the next 6 months? Well, you made a total of 200K, but again, your payroll doesn't know that you had a job before that making 100K. They don't know that. They only assume that whatever income that you have from this job that you're filling out the form for that's it. So this is how you under withheld. So what needs to happen is you have this, and again, payroll doesn't see this, but you have to know your whole tax situation. So what I would recommend is a couple of things. And this is the key. First, grab pay stubs. Okay, first 2 steps. Here's how I would recommend preventing this problem and getting your withholding locked down. This is high level. I'll give you a little bit more specific tips, but this is what I would do. Grab your latest pay stub. If you get paid semi-monthly, you probably have one from June 30th. July 15th, I guess, is tomorrow as of this recording, but you would grab June 30th, half a year, right? You would also have to estimate any other sources of income. So grab all of your pay stubs, all of your income. At the end, what you're trying to do is estimate. What you're doing is you're estimating, this is where my income is now. Where is my income going to be at the end of the year, right? So the next thing is estimate the tax withholding. How do you do that? The way you do that is look at your pay stubs and say, okay, I have $10,000 withheld as of June 30th. Well, assuming that you're not going to get any bonuses or weird things like that, it's going to throw it off and it's going to be your no raises. Chances are if you had $3,000 withheld, you're probably going to have $6,000 by the end of the year, right? If your last stub that you pull is June 30th, right? 6 months, probably going to have the same withholding, unless you make any changes to it. So that's what you do. And so then you can use, the next step, I recommend IRS has a good withholding calculator. You can also use, there's apps out there like Taxcaster. I think H&R Block might have one too. Software programs. They also have software programs that you can use. Or you can just engage your CPA, pay them a couple $100, and they can kind of walk through and figure out what your estimated tax liability is. Now, when I go back to this, you're estimating other sources of income. This also means that you need to estimate like any kind of tax liabilities that you may additionally have, like self-employment tax if you have a Schedule C. What I'm saying is you need to estimate all of your income. And you need to estimate, like if you have business, self-employment income, estimate that, estimate capital gains. You have to make these estimates to avoid surprise tax bills. So get it all out there, okay? And the more data you get, the better the estimate will be, the better the withholding accuracy will be, and the happier you'll be at the end of the year because you won't have a big surprise tax bill. So you do all this, okay? And then what you're going to do is update your W-4s. So what that means is if you and your spouse work, you can update your W-4s. You can also decide to pay in quarterly estimates if you want. Now, we'll talk about that in a second with the quarterly estimates versus just paying in withholding. There's some key points there. But what we want to do is, in general, we want to update the W-4 to either reflect more withholding, less withholding, however you want to have that done. Then what we'll do check and repeat. Now what this means is you're going to check your latest pay stub and make sure that, again, if the withholding needs to be increased, did it increase the amount that you need it to go up? If it did, great, you're done. If not, what you'll have to do is go back to the drawing board and fill out another W-4. It's an iterative process, but it's important because we want to make sure we get it right. And so this is kind of the steps that you do. Now, let's talk about these, what I talked about earlier with quarterly estimates versus payments. So how the IRS treats a quarterly payment is you generally pay your first on 4/15. And this is going to be first, second, third, fourth. So the way that the IRS treats your quarterly estimates when you pay them They're treating it as like a point in time. Like, okay, I paid this on 4/15. I paid this on 6/15, 9/15, and 1/15. This is January 15th, September, June. And these are first, second, third, and fourth quarter. So your fourth quarter payment is due in the following year. Now, what this is doing is these are the due dates that the IRS sets. And if you end up owing a lot at the beginning of the year, in other words, or you end up owing a lot, they could assess an underpayment penalty. Because let's say you said, hey, I don't want to pay 4/15 or 6/15. I don't want to pay those. In fact, I don't want to pay 9/15. I want to pay it all then. They could say, well, you owed money these 3 quarters. Like they could say, okay, let's take your income of, I don't know, $100,000 and divide it by 12. And they could have said, well, you had income here and you didn't withhold. You didn't pay us. And this is typical for businesses. A lot of businesses, because they don't have withholding. Like if you have a side hustle, you don't have withholding. You're paying in these quarterlies. But if you made income on your business throughout the year, you're supposed to be paying in these, and they'll assess an underpayment penalty. It's not much. I forget what the number is off the top of my head, but it's not much, but it's still going to be a penalty because you should have paid in. The cool thing is, and here's the trick, is with withholding, it's treated as being made year round. So here's the crazy part. If you made a huge, let's say you got a bonus at the end of the year. Let's say you got a bonus here, okay? And we're using a timeline. We'll say at the end of the year. I don't want to get into January there. So at the end of the year, you got a big fat bonus. We'll say $10,000. And you realize, yeah, I think I'm going to owe $10,000. Well, you could work with your payroll department if they'll allow it and say, I want that all to go to taxes. The cool part is even though you paid here, okay, at the end of the year, in the IRS's views, withholdings are treated as being made ratably. In other words, it's treated as if it was made throughout the year. So even though you paid the $10,000 at the end of the year, the IRS looks at it as, no, it was withheld every paycheck. So what this means is, if you have side hustle income and you've been behind on your quarterlies, one option to help avoid penalties is to increase your withholding. If you or your spouse has a W-2 job, increase that withholding, and that will help. So hopefully this helps, and hopefully this gave you a little explanation. If you have any other questions, be sure to shoot them to me, a comment on YouTube, or you can follow me on Instagram at mdeepcpa. That's MDEEPE CPA, or on Twitter, mdeep, same thing, _. So a little underline CPA. Y'all have a